systems provide a misleading target for managerial attention. They fail to provide the relevant set of measures that appropriately reflect the technology, products, processes, and competitive environment in which the organization operates. Originally designed earlier in this century to help coordinate the diverse activities of emerging vertical integrated enterprises, financial measures such as return on investment have become, for many organizations, the only measure of success. Financial managers relying exclusively on periodic financial statements for their view of the firm get isolated from the real value creating operations of the organizations and fail to recognize when the accounting numbers are no longer providing relevant or appropriate measures of organizations' operations. The challenge that management accounting face is global competition, rapid growth in product and technology, and fluctuations in currency exchange rates and material prices. Management accounting system needs to report accurate product costs so that pricing decisions, introductions of new products, and responses to rival products can be made with the best possible information. Consecutively, decentralized organizations require systems to motivate and evaluate the performance of their managers working in different functions with diverse products and processes. Finally, even if management accounting system is efficient, success depends on the products that meets customer needs, on efficient production and distribution systems for these projects, and on effective marketing efforts. As an efficient management accounting system can undermine even the best efforts in product development and process improvement and marketing policy. The opportunity of management accounting started when demand rose at one point where costs of collecting, processing, analyzing, and reporting information started to decline. Moreover, production processes under direct control of digital computers, information can be recorded in real time for analysis of operating performance. In highly automated environments, virtually every transaction can be captured for subsequent analysis. Automated parts recognition and tracking systems combined with local area network technology can provide continual status reports on work in process. Thus, extensive system now can accurately measure, attribute the resource demands made by each product in a diverse product line. Timely and relevant managerial performance measures can be computed and disseminated throughout the organization. The history of management accounting started in the early 19th century, when virtually all exchange transactions only occurred between an owner and individuals who were not part of the organizations. For example, raw material suppliers, labor paid by piecework, and customers. These transactions in the market were easily obtainable. There were no such things as levels of management. Owners only needed more cash from sales to customers than it was paid out to suppliers or factors of production, such as labor and material. After the Industrial Revolution, hierarchy organizations created a new demand for accounting information, as conversion processes, which formerly were supplied at a price through the market exchanges, became performed within organizations. A demand arose for measures to determine the actual cost of an output from their internal operations. By the middle of the 19th century, great advances in the transportation and communication, especially the invention of railroads and telegraph, provided further opportunities for gain in large, hierarchical organizations. These enterprises could now coordinate the acquisition of raw materials and the distribution of final products over much larger geographical areas. In fact, effective management accounting systems were necessary to coordinate efficiently the logistical, conservation, and distribution activities of these enterprises and to provide summary measures of the performance for decentralized and dispersed managers. Further advances in technology and management accounting systems were made in conjunction with scientific management movements. This movement started in metal fabricating companies during the last 2 decades in the 19th century, while the goal of the specific management ways was to improve the efficiency and utilization of labor and material. The physical standards they developed, such as labor hours per unit and materials quantities per unit, were easily converted into standards for labor and material costs. The final developments in management accounting systems occurred in the early decades of the 20th century. The support growth of multi-activity, diversified corporations. These corporations needed to coordinate the diverse activities in a vertical, integrated manufacturing and marketing organization, and deciding on the most profitable allocation of the capital to these different activities. The only important capital choice was whether to expand the scale of one homogeneous operation or several diverse operations that should be expanded. But the most important and the most enduring management accounting innovation was the return on investment. Return on investment provided an overall measure of the commercial success of each operating unit and the entire organization. Only top managers use our return on investment to help direct their allocations of capital and to evaluate the performance of the operating department. Nowadays, decentralization was necessary and each operating division requires its own staff per functions to support its activities. Thus, central managers were now in position of providing capital to diverse operating units and attempting to coordinate, motivate, and evaluate the performance of the divisional managers. The return of investment measure played a key role in permitting this internal market for managers and for capital to function.
So right now, I'm going to discuss whether management accounting system is irrelevant. Management accounting system were failing to provide relevant information for management planning and control decision, and the problem that managers considered very important are not even broached in the usual management accounting curriculum. For example, problems such as managing overhead costs or managing product quality. Next, information supplied by the accounting departments often resembling the information that management accounting student does not solve the problem that mattered to them. The accounting system were lagging far behind the manufacturing process. Changes being implemented by innovating companies in manufacturing and in deregulated service industries. Not to mention, traditional manufacturing technologies who had not made major changes in their operation and equipment also had management accounting systems that were completely inadequate for cost control and for production planning decision. That's when the obsolescence of virtually companies' management accounting system become apparent. So next, here are some typical examples of problems caused by the failure of management accounting system to provide relevant data for management planning and control decision. First, most basic in that virtually no multi-product organization today knows the cost of each of its products. The cost accounting system is the only system for estimating product costs. Today, the system do a miserable job of tracing the consumption of indirect or overhead resource to products. Next, the system also provides misleading target for manufacturing managers. Finally, monthly and quarterly income figures provide a poor target for the value-creating activities of organizations. In a nutshell, when a complex, diversified organization do not produce valid information about the effectiveness and efficiency of their internal operations, they become vulnerable to smaller and more focused competitors. This is because focused enterprises have much simpler information needs. They can become highly efficient in their narrow product segments or range of product processes will outperform diversified organizations. Due to inadequate management accounting information, can assess the relatively profitable of the varied activities. Here's some non-financial measures that should be developed and implemented to improve decision making. First of all, organizations stressing total quality control and zero defect policies will want to measure yields, the incidence of failures internal and external to the organization, the percentage of items produced that require no rework, and so on, whereas organizations attempting to implement just-in-time production segment may want measures average setup times, days production inventories, and average travel distance for products. In fact, innovative Japanese companies are now managing time, not cost. This could be a profound change for US management accountants, especially those trained to think only about financial measures. The characteristic for future management accounting systems should distinguish clearly between two types of information. First, strategic profitability information, and process control information which can be derived from the same system, the financial accounting system. Next, there must be a system that provides relevant information for controlling an organization's processes. In the final analysis, the management accounting system must help managers answer one fundamental question: why does this organization exist?
Assalamualaikum and hi, I will continue to discuss about loss relevance based on the article The Rise and Fall of Management Accounting. Management accounting that practice today had developed by 1925. For example, cost account for labor, material, overhead and many more. Thus, practice had evolved to serve the informational and control needs of the manager of increasingly complex and diverse organization. Unfortunately, the pace of innovation seemed to be stopped in the mid of 1920. There was incentive and encouragement to continue to develop innovative management accounting procedure. Then the diversity of product and complexity of manufacturing process continued to rising after decade 1920. Therefore, the need for accurate product cost and effective process control should have imposed new demand on organization management accounting system. But after 1920s, the evolution of management accounting did not keep pace with the improvement in corporation product and process technology, and this led to this problem that is distorted product cost, delayed, overly aggregated process control information, and short-term performance measures that do not reflect the increase and decrease in the organization economic position. This stagnation can be attributed to the dominance of the external or financial accounting during the 20th century. The demand for periodic and audited financial statement increased. Audited preferred conservative accounting practice based on objective verifiable and realized financial transaction. Auditor also wanted the income statement and balance sheet to articulate. Then the simple method were used to assign direct and period costs to product. The cost of collecting and providing prompt report to production manager have been too high to permit the real-time process that is now possible. The decision made by manager not to invest in management accounting systems separate from those already mandated by the demand for audited periodic financial statement may have been correct for economic decision. This advantage for more accurate and responsive management account might not have been worth the cost of maintaining. And as the time passes, the spirit and knowledge of management accounting system design that took place over the 100 years have vanished. Organization had fixed in the core system and management reporting method of the 1920s. When core system became automated on digital computers starting in the mid-1960s, the system designer basically automated the manual system they found in the factory. It left unquestioned was whether the system were still sensible given the great expansion in information technology represented by electronic and digital computer. Thank you.
Academics led astray. Why did university-based researchers fail to note the growing obsolescence of organization management accounting system? And why did they not play a more active or stimulative role to improve the art of management accounting systems design? The article believed academics were led astray by focusing too narrowly on a simplified model of firm behavior. Influenced strongly by economists' one production process model of the firm, management accounting academics found little value in the cost of allocation imposed on organizations by financial accounting procedures. 60 years of literature emerged advocating the separation of costs into fixed and variable components for making good products decisions and for controlling costs. However, they never fully addressed the questions of where fixed costs came from and how these costs needed to be covered by each of the products in the corporation's repertoire. The academic researchers do not attempt to implement their ideas in the environment of actual organizations with hundreds or thousands of products and with complex multi-stage production processes. Thus, the academic literature concentrated on elegant and sophisticated approaches to analyzing the costs for single product, single process firms, while companies tried to manage with antiquated systems in settings that had little relationships to the simplified model assumed for analytical convenience by researchers. Ironically, as management accounting systems become less relevant and less representative of the organization's operations and strategy, many companies became dominated by senior executives who believed they could run the firm by the numbers. In succeeding decades, however, chief executives were selected whose entire careers were spent in staff functions such as finance and legal. Lacking knowledge and uncomfortable with their firm's underlying technology, these CEOs increasingly look at the projected short-term impact will be on financial measures when making decisions, especially earnings per share and return on investment. But as product life cycles are shortened and more costs are incurred before production begins, directly traceable product costs become a much lower fraction of total costs. Consequently, traditional financial measures such as periodic earnings and accounting ROI become less useful measures of a corporate performance. Accounting for caravans is not a new phenomenon. In the 15th century, we can ask what kinds of events were occurring that led to a demand for accounting information. Undoubtedly, merchants in Venice were trading goods with other countries. The articles give an example of a group of Venetian investors who acquired goods produced in northern Italy and chartered an expedition to sell these goods in India. Once the goods were sold in India, the traders purchased tea, traveled back to Venice, and then sold the tea. At the end of the expedition, the accountants subtracted the cost of the caravan and the cost of acquiring the initial lot of merchandise from the revenues received from the sale of the tea in Italy to compute a profit for the entire trip. A profit is then to be distributed among the investors in the venture. This was a worthwhile role of accounting to compute the overall profitability of the venture and to distribute the net proceed among the initial investors. However, did the investors of the Venetian version of the SEC or FASB also ask the accountant to compute the expedition's profits during the third quarter of 1487 when the caravan was traversing the Persian desert en route to India? Probably not. Investors understood that allocating the total profits of expeditions to period as short as 3 months was not meaningful. Arguing that it is meaningless to allocate project profitability to short time periods within the life of a project does not imply that we believe it is fruitless to attempt to obtain valuable indicators of short-term progress. There are many indicators that the investors were interested in knowing. For example, what distance did the caravan cover and in what direction? How many provisions are left? What is the condition of the inventory being transported? Are the workers content or rebellious? There are many potentially useful indicators. And given the current competitive technological environment, there are probably many better indicators of a company's short-term performance than its quarterly earnings. But knowing sources and uses of cash is very different from working hard every month and every quarter to produce complete income statement and balance sheet. Last but not least, needed innovation. The challenge and opportunity for contemporary organization is clear. Management accounting system can and should be designed to support the organizations and the strategy of the organization. The technology exists to implement systems radically different from those being used today. What is lacking is knowledge, but this knowledge can emerge from experimentation and communication. This can be done with the help of creative managers and academic researchers who are committed to developing the new concepts for designing relevant management accounting systems.